Leading up to the vote on the 23rd of June, the EU referendum, there'd be much chat about banks and where ultimately they would end up. Would they have to operate outside the UK in order to achieve successful operations within the EU if we went for a Brexit? Well, here we are now, a week on from the vote, and all of a sudden now the focus has come back onto British banks, because all of a sudden the likes of Barclays now suggesting they're even looking to shed jobs here in the city. Chris Tinker joins us now, who's a founding partner at Libra Investment Services. Chris, it's good to talk to you. What about the banking sector here in London now? How do you view things? Because leading up to the vote, as I said, there was much talk about just how many banks would have to leave the UK in order to continue operations in Europe. But now here we are, looking like the European centre, looking like it could remain in London.
Well, I think first and foremost, the European centre will remain in London. And this is the challenge that we have. In the run-up to the referendum, there was almost an exclusive focus on the banking system and its access to Europe from London, as if there isn't a banking operation outside of Europe, which is obviously not the case. And I think the international nature of London, the time zone, the language, rules of law, operational systems, services, skills, all of those things, none of those things have changed, but the relationship to Europe is now on a path of transition. We recognise that this is not about a banking system that's no longer able to operate. We've still got a period of time, 2 years or more, during which time negotiations are going to be made on both sides. And we shouldn't lose sight of the fact that European companies and businesses will want access to London. They won't want us to be denied the ability to operate in this time zone in a financial market as deep and as liquid as London with its expertise. If you're a European operating company, you're going to be saying to your own banking system and to your own regulators, let's not ruin what we need here. Let's recognise that access is important. There are going to be areas of focus, but nothing like the singular focus on only downside risk we saw in the run-up to the referendum.
But one of the threats there was here for the banking sector leading up to the referendum was that if you do vote to go, you will lose all protection that within the European Union. You will lose the operations there because there will be this problem with passporting. You won't get that. Is that no longer the case? I mean, what's changed?
Well, I think a little knowledge has been a dangerous thing in this regard. I mean, the rules around passporting combined with the migration to MIFID II regulations by the beginning of 2018, it was nearly 4 months ago that we realised, only 4 months ago, that we realised that MIFID II was actually going to be starting in 2018 rather than 2017. But what that does mean is that even if we invoke Article 50, we will still be operating within the EU when MIFID II regulations come into play, and most of the passporting relating issues are covered by MIFID. So what's likely to happen is, even if we leave the EU under third-party country arrangements with the EU, there is no ability to discriminate against a third-party country. There will be areas which the ECB will want to focus on, and make sure that their rules are met. But these are areas of concern. I mean, euro-dollar clearing, for example, euro clearing being brought back onto continental Europe. We're currently in sort of a legal discussion with the Germans and the French, who have been trying to bring euro clearing back into euro area countries and haven't been allowed to. We've still got the euro clearing in London. But these things are going to be changing anyway, potentially. So this isn't as if we've gone down a different, an unknown route. So I think what the banks are realistically saying is, yes, there's a risk. We may need to relocate. Should the rules change to the point where we can't operate, we will relocate. But the clear message, I think, from the banks is we do not want to relocate. We feel we can operate from here. We feel we can give that service to European companies and European financial institutions themselves, which they will want, and it's to the benefit of all. Bear in mind, there is no free market in services within Europe. Free trade, but not free services. So there isn't an agreement that we're going to be unbinding from. It's really the regulatory level of decision making that could change, but doesn't have to.
Yeah. On Monday morning, straight out of the blocks, we heard the Chancellor of the Exchequer, George Osborne, come out with the knowledge of where the vote had gone, obviously, and to say that British banks were well capitalised. They're far better off than they were in the financial crisis 7 or 8 years ago. Is that true? Much of what's been said by politicians has been rubbished recently in the lead up to the vote. Is it right? Are we in a good place now? Are banks safe? Are we fully capitalised and well prepared for the headwinds that might approach us?
I'd hate you to put me on record as claiming something that I couldn't possibly confirm in terms of individual banks' capitalisation. But as far as the Bank of England's oversight and regulatory inputs have been concerned in the last 4 to 5 years, there's no doubt that the capital infrastructure has been reviewed, been stress tested, been analysed. And that's been an important part of this recapitalisation programme that the banks have taken on board. It's one of the reasons why the banking sector has been such a poor performing sector as far as equity investors are concerned, because of the impact that that's having on profitability, impact that's having on the ability to pay dividends. We've still got the rump of Lloyds, we've still got RBS, we've still got these issues to deal with going forward. But the nature of the risk positioning, the nature of the exposure that the UK banks have taken has changed out of all recognition in the last 7 or 8 years. So although it's a risk that politicians always like to fight the last battle, there's no doubt that from a regulatory capital point of view and a risk position, just have a look at Basel III regulations, the UK banks are well positioned to survive risk and uncertainty in financial markets. Whether they're actually maintain themselves as viable, expanding, profitable businesses against that backdrop, that's a different question. But in terms of operational ability, I don't think that there's any comparison between the pre-2008 era and where we are today, where the Bank of England's supervision is very, very strong.
Yeah, one final question has to be about the Bank of England. Mark Carney there talking about they will release whatever money is necessary towards the banks to keep liquidity going. Do you see that scenario coming about? I mean, no one knows exactly how fierce the headwinds are coming to the British shores for whatever reason, be it China or this breakup of the EU. From our perspective, do you see that money will have to be drawn from the Bank of England to support the banking sector? Would you not be surprised if that was the case?
I think what we learned in 2008 was that the swap line arrangements being put in place between the Federal Reserve, the Bank of England, central banks in Asia and in Europe, the ECB, as well as the Bank of Japan and Singapore, these swap arrangements proved to be very successful. So it's no surprise that the Bank of England has identified that these arrangement facilities are already in place. If you get liquidity stresses in the system, they're there and they will be called upon. But I don't anticipate that they're put in place because of concerns. I think it was a strategic decision. We learnt the lesson last time. They're there if they're needed. And I think that's a comfort to markets. And I think that's really Mark Carney's message, is to say, we've got this one covered. You don't need to be concerned, and I think that's a good thing.
Good. Okay, all right, Chris, thanks indeed there for joining us. Chris Tinker is a founding partner of Libra Investment Services.